Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden in plain sight within the world of business filings. Today we're diving deep into a prospectus supplement from the Gabelli Multimedia Trust Incorporated. And let's just say this one has more layers than an onion dipped in a data lake. This document is essentially a company telling us about new shares they are planning to sell. It is like a company announcing they're opening a new store, but instead of selling shoes, they're selling more of their own stock. They've already sold a good chunk and still have plenty left to offer. The key thing here is that they mention you can't sell shares for less than their current net asset value per S-Hair, which is a pretty standard rule to protect investors from ridiculously low prices. So what exactly is this Gabelli Multimedia Trust Incorporated all about? Imagine a company that invests in other companies, primarily those involved in media, entertainment, and telecommunications. Think of it like a club that buys pieces of companies that make or distribute movies, music, or phone services. Their main goal is to grow the value of their investments over time. Their stock is traded on the big stage, the New York Stock Exchange, under the ticker symbol GGT as of the 17th of February 2026. The stock was going for $4.04. They also have preferred shares, which are a bit like a special class of stock, listed under symbols like GGT Pre and GGT Par G. Now let's get to the nitty-gritty, the financial meat of this document, which comes in the form of tables. These tables are where the real story is told, and they show us how the company has been doing and what they expect. This capitalization table gives us a snapshot of the company's financial structure. We see preferred shares and stockholders' equity. In the actual column, we see numbers as of the 30th of June 2025. Then, as adjusted, shows us a picture after some changes, like issuing more shares for their dividend reinvestment plan and through their ongoing offering. The as further adjusted column is the most important here, as it shows us a hypothetical scenario where they sell even more shares, specifically 100307, 12 shares at $4.04 each. If they sell all those shares, their net assets applicable to common stock would jump from roughly $156 million to over $196 million. That is a significant increase in their value on paper. The table breaks down the equity for common stockholders, showing the par value of the common stock paid in capital and total distributable earnings paid in capital, which represents the money investors have put into the company for stock, would increase substantially in the as further adjusted column, reaching about $163 million. This shows the potential influx of cash if they sell all the shares they've registered. This section on fees and expenses is crucial for understanding the true cost of investing. We see a sales load or commission of 1.00%. This means for every dollar you invest, a penny goes directly to the sales manager. Then there are offering expenses borne by the fund at 0.33%. which means the company itself covers about a third of a penny for every dollar raised to pay for the costs of this offering. They also detail annual expenses like management fees, which are 1.34% of net assets, and other expenses at 0.38%. When you add it all up, total annual expenses come to 1.72%. But then they add dividends on preferred shares, which brings the total annual expenses and dividends on preferred to a whopping 3.45%. That is a pretty high ongoing cost for investors to stomach. Looking at the management fees at 1.34% and other expenses at 0.38%, it is clear that running this fund comes with significant ongoing costs. These percentages might seem small, but over time they eat into your returns. The example shows that on a $1,000 investment with a hypothetical 5% annual return, you'd pay $35 in total expenses in the first year and $373 over 10 years. If you remove the preferred share dividends from that example, the cost drops significantly, highlighting the impact of those preferred shares on the overall expense ratio. This section tells us where the money from selling these new shares will go. They estimate that if they sell all 10030712 shares at $4.04 each, they'll net about $40 million after deducting the fees. This money is intended to be invested according to their strategy, which means buying more stocks in those media and telecom companies. They expect to invest it all within 3 to 6 months. Interestingly, they also mention they might use this money to redeem or repurchase their preferred shares, which could be another way to manage their capital structure. Here we see the historical performance of their common stock, showing both the market price and the corresponding net asset value per S-Hair. What is striking is how often the market price traded at a significant premium to the net asset value. For example, in the quarter ending the 31st of March 2024, The high market price was $6.11 while the net asset value was only $3.75, a premium of over 62%. This means investors were willing to pay a lot more than the actual underlying value of the stock. As of the 17th of February 2026, the stock was trading at a 9.19% premium. This premium trading is a key characteristic of this fund and something investors need to be very aware of. This table provides a clear picture of the company's outstanding securities as of the 17th of February 2026. They have a large number of common shares outstanding, over 40 million. They also have Series E and Series G cumulative preferred shares. Notably, for the Series G preferred, they show 1202483 shares outstanding. But in the amount held by fund or for its account column, it is empty. This implies the fund itself isn't holding onto those shares. This is a critical risk factor. They explicitly call out the potential for buying shares at a price higher than their actual worth. If you buy at a premium, you are essentially paying extra for something that is already worth less. This isn't a small quirk as we saw in the price range table. This fund has a history of trading at substantial premiums to its net asset value. It raises questions about market sentiment versus fundamental value. This section talks about how the company distributes its earnings to shareholders. They've moved to monthly distributions for common stockholders, which sounds nice and accessible. However, they also caution that a portion of these distributions may be a return of capital. This means you might be getting some of your original investment back, not profit, which can misleadingly make you think you are earning more than you are. They made it clear that the distribution rate should not be mistaken for dividend yield or total return. This part of the plan of distribution outlines how the shares will be sold and who gets paid. The sales manager, G Research LLC, will earn commissions. For daily trading amounts up to 2,000 shares, the commission is no more than 1.00%, and for amounts over 2,000 shares, it is no more than 0.75%. This is standard for at-the-market offerings, where shares are sold over time. They estimate total expenses for this offering, including the sales manager's compensation, at around $457,241. While not a direct financial number, knowing who audits the company's books, like PricewaterhouseCoopers LLP, gives a sense of the accounting oversight. This is a prestigious accounting firm which generally lends credibility to the financial statements. This is a standard legal disclosure telling investors that other company documents like annual and semi-annual reports are officially part of this filing. It is like saying, hey, if you really want to know everything, go read these other reports too. They list specific reports like the annual report for the fiscal year ended the 31st of December 2024. And a semi-annual report from the 30th of June 2025. This is the core of their investment strategy. They are focused on growth by investing in specific sectors. This concentration can be a double-edged sword. It means if these industries boom, the fund can do very well. But if they face challenges, the fund could be hit hard. It definitely limits their diversification. This section gets pretty technical with rules about regulated investment companies or RICs. Essentially, to avoid paying corporate income tax, the fund has to distribute most of its income and capital gains to shareholders. If they don't meet these distribution requirements, they face taxes. They also mention a 4% federal excise tax if distributions fall short. This shows the legal and accounting framework they operate within to manage their tax obligations. This part explains how investors themselves will be taxed on distributions from the fund. Ordinary income dividends are taxed as ordinary income. Capital gain dividends are generally taxed at lower long-term capital gains rates. But here is a crucial point: distributions can be a return of capital, which reduces your investment cost basis. This can be confusing because it looks like income, but it is actually you getting your own money back, which defers tax until you sell. This section is packed with legal jargon related to anti-takeover provisions. They've got a classified board of directors, meaning only a portion of the board is elected each year, making it harder for shareholders to quickly change leadership. They also have supermajority voting requirements for significant corporate actions like mergers or asset sales. These provisions are designed to protect the current management and board from hostile takeovers, but they can also make it harder for shareholders to influence the company's direction or sell their stake at a premium. This explains the fundamental difference between this fund and a typical mutual fund. As a closed-end fund, its shares trade on an exchange and don't get redeemed at net asset value. This is where the discount to net asset value becomes very relevant. While open-end funds always trade at net asset value closed, end funds can trade at a premium or a discount. This fund has a history of trading at a premium which, as we saw earlier, can mean investors are paying more than the underlying assets are worth. Overall, the Gabelli Multimedia Trust Incorporated presents a complex picture. The company is focused on growth in specific sectors and its structure as a closed-end fund means its stock can trade at a premium to its underlying value, something investors should be very wary of. The management fees and expenses are on the higher side, and the various anti-takeover provisions can make it harder for shareholders to exert influence, although they're also designed to provide stability. The potential influx of cash from selling more shares is significant, but the ultimate impact on shareholder value will depend on how effectively management invests that capital and whether the market continues to value the shares at a premium. So, what is my take if you are an investor? You need to understand that you might be paying more than the actual sticker price for this fund's assets due to the premium. The high expense ratio is also a significant hurdle. While the focus on specific growth industries could pay off, the lack of diversification and the trading at a premium are substantial risks. It is a fund that requires careful consideration of its unique structure and fees. What are your thoughts on investing in a fund that consistently trades at a premium with a high expense ratio? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate deep dives. And hey, we've got a fantastic community over on our Discord server linked in the description where we discuss these kinds of filings and much more. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.